So regarding interest rates, I wrote an example where we start with an initial investment of $1,000 just because it's an easy number. And we're going to invest over a period of 30 years. And this is kind of going to show the after inflation value of an investment using various different methods. So if you these percentages should be close to accurate. They might not be 100% depending on your bank or exactly the day you're watching this. But so if you invest in a bank savings account, the interest is minimal. You're looking at 0.6%. It's even less than inflation. So you're actually losing money to inflation if you do this, but it's better than just collecting cash. Treasury bonds, they're commonly referred to as the risk-free rate, just because it's unlikely that the government will fail. It's not truly risk-free, but that is what people mean when they say risk-free rate. They're talking about treasury bonds. Bonds refer to corporate bonds, which are companies trying to raise money. Funds is mutual funds, index funds. It's a group of stocks managed by someone else. So there's less risk, and you don't have to be quite as educated in stocks to invest in funds because you're paying somebody to do it. And that's where this discrepancy is, because if you were to invest in stocks, we just had a really great couple years, so the growth is pretty big. But so the average stock growth on the S&P is about 11.8%. Perfect. So what we're going to do, take our starting value. We're going to multiply it by 1 plus the interest rate. So for this example, we're starting with the bank savings account. We're getting 0.6%, so $6 off our $1,000, and then another $6.04 off our $1,006, $6.07 off of there, and so on. So we're going to carry that all the way down to 30 years. As you can see, it's not very much. We gained about $200 in 30 years, and after inflation, it's only worth about $429 in today's money. So you're still, like, there are better ways, and I just kind of wanted to show this. So if we move that over to the risk-free rate, the treasury bonds, you're looking at $3,600 or $1,300 of inflation-adjusted 24 or 2024 dollars. If we do bonds, you're looking at $4,500 or $1,600. And then this is where it gets good. If you start to put your money in mutual funds, there's more risk, and there will be ups and downs. But over the period of 30 years, it's very likely to balance out. But so your $1,000 turns into $13,000, which will be closer to $5,000 after the inflation adjusted. And then if you really want to quit your job, research your own stocks, and that's what you want to do for hours a week, you can. Absolutely, people do it. People make a lot of money doing it. So just that 3% difference, it's huge. Like it can't be understated. So your $1,000 is worth $28,000 by the time you retire. And obviously you could scale this up. If $1,000 is worth $28,000, then $1 million would be worth $28 million. So you can, this builds up. So then over on this page, I have another example. This is more the practical application. But this one gives us the option to add a recurring investment. So the way this formula works is we take the field above it, we multiply it by 1 plus the interest rate, and then we add our recurring investment. So say if you want to be responsible, you want to do the Dave Ramsey thing and invest 10% of your income. I believe the average American income is somewhere around $50,000. So assuming you can afford it, we're going to invest 10% of that, which would be $5,000. So we'll actually start with 0 just to make it easy. So this is just $5,000 a year. At your bank, right? You're losing money. You saved after your interest, you saved $169,000. After inflation, it's only $61,000. Just for comparison, if you kind of the basis, 5,000 times 30 is going to be 150,000. So that's the no growth. So that is the baseline that we're comparing these numbers to. But so if you do treasury, you're looking at 319,000. If you do bonds, you're looking at 364,000. If you do funds, you're looking at 750,000. And if you do stocks, you're looking at $1.3 million, which is great. And so this is just to show that you don't need to make a ton of money in order to have a retirement. But so if you invested $5,000 a year for 30 years, you could retire with $750,000 if you did it moderately risky with a mutual fund. This is just a very distilled, simple way to kind of get a perspective for how interest works. This is also, I wanted to use this to kind of address one common issue that I hear coming up. So a lot of people, a lot of older individuals say, if you want to save money, skip the morning coffee, right? And then the younger people say it's just a coffee, like it's $5. It's not going to. Well, they say some defense. So like you can multiply, right? $5 times 365 is $1,825 a year, which is nowhere near a down payment for the house, right? But what they're failing to account for is the time value of money. So as we've seen here, interest is a big deal. So if you, for example, you buy one $5 coffee, that the $5 is not a lot, but what is a lot is the time value of the opportunity cost of the $5. So if instead of getting a $5 coffee, you invested in a fund, right? 30 years from now, that $5 coffee is worth $66. And you can extrapolate this further. So we'll say if you're 18 years old, the average lifespan maybe is like 88. I believe it's mid 80s. But so say even like conservatively, like you die young, right? You die 60 years old. We'll give this 42. Your $5 coffee is worth $186 if you invest in mutual funds. So that is why they start to add up. So then if you take this, the 186.59 times 365, that's $70,000 you spent on 1 year of coffee when you were 18. That's $70,000 worth by the time you retire. So that's kind of what people are talking about, and that's why that perspective is important. The time value of money is important to take into account. So this is kind of my intro to finance. This is a very brief summary of what I learned my first finance course in college, and I think it's just a good place to start. So I will hopefully do more videos like this if people like it. If they want to hear more stuff, feel free to let me know. I'm not personally a fan of when people give their disclaimers at the beginning of YouTube videos, because I personally don't feel like I'm going to attack people on a personal level because of their views in a video. But I do think it's important, especially when dealing with finance, to emphasize that I'm not a financial advisor. I'm not telling anybody to go quit your job and invest in stocks. I think that is a life that I do not feel that I would be interested in living myself, just because it's so much work and the risk is not worth it for me. So if that's what you got from my video, please don't think I'm advising you to quit your job and invest in stocks. I view investments as a supplemental income that is definitely something that over time can become something that can become an income that you're dependent on. But that is down the road. I'm not encouraging anybody to do that. I just wanted to kind of get this or help people get this into perspective, because spreadsheets help me visualize it. I know a lot of people are not interested in this kind of thing. From my own experience, I try to talk to my peers about it, and they don't really seem very interested. But I am interested, and I think it's an important thing to know about. So that's kind of why I wanted to share it. But yeah, I will try to do more videos like this. If you want any specific lessons on anything, please feel free to leave a comment, like, subscribe, shoot me a message. I'm just doing this for fun, and I don't foresee it blowing up, so I should be pretty reachable if you have a finance question that you want me to see if I can figure out for you.